Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining me. On today's program, I'm looking at a number of stocks that came from a story that I wrote in the Switzer report. And I thought, well, there's a list of stocks that are shorted on a regular basis, and I actually show them in our Saturday Switzer report. And I thought some of these stocks are really liked by the analysts. So I decided to look at the top 20 most shorted stocks and compare it to what the analysts were saying about the companies. I found that there were a list of very interesting companies where the analysts could see, in the case of, say, Domino's, a 29% rise, Flight Centre, 25% rise. But the analysts like it, but the short sellers are short selling it, not liking these companies at all. So I tried to reconcile the differences. My producer and I decided to call them the much maligned seven, not the magnificent seven, but the much maligned seven. And so I thought I've done the fundamental analysis and I relied on the views of analysts themselves. But I thought, let's talk to Mike Gable, the chart guy from Fairmont Equities, to see what the charts are saying about these companies. Is it time to buy them now? Are the short sellers wrong and the analysts right? Let's just see what Mike Gable tells us. Thanks for joining us, Matt.
Thanks, Peter.
Yeah, it's that time of the month when we look at the charts and see what companies are looking good. And I've written a piece in the Switzer report today where I've actually looked at the companies that are most shorted on the stock market, and I've looked to see what the analysts are saying about the companies. So I've looked for conflicts.
Yeah.
So all these companies are shorted, but they've also companies where most of the analysts like them, and they like them big time. And the starting point is Domino's, DMP, and here the consensus view on Domino's is 29.7%. So there are some analysts even more, and there's at least 5 or 6 out of 6 who like this company, including June Bailey of 10 Cat. And she's not easily fooled into buying pizza because she likes the taste of it. So what are the charts saying about Domino's?
Yeah, at the moment, we still have that mismatch. So, we still have a chart that's trending lower.
Yeah.
There's no clear signs that it's bottoming out. When you get a stock like this that is heavily shorted, yeah, that is exciting because when it does turn around, you've got all those shorts to cover and you could end up with double if you move. But we're just no signs of that. Yeah. So it's still a keep on the watch list situation. Yeah. What we want to see is potentially a base get formed. So it needs to maybe hit sideways for a while and then needs to start making higher highs, higher lows, all that sort of thing. So if I miss the bottom 20% by waiting for the chart to turn around, but yeah, potentially there were people out there thinking that, some of these levels were automatic or continue forwards.
What's that price in relation to the history of Domino's?
Yeah. So look, at the moment, we're talking a $13 stock that could trade up at $160. So you could see that, yeah, it's easy to get in too early. And dare I say, a lot of those large, broking firms, analysts, I bet if you plot their price targets over the past few years, the target's probably following the share price down lower and lower as well. So it's probably looked cheap for a long period of time. But I think the targets have followed it lower.
And when management's changed, Don May was there in the beginning, fantastically well. Yeah, international division haven't done as well as expected. But at this point in time, the chart is not giving you any confidence that now is the time. But we'll watch it. We'll watch it over time.
Yeah, and it's got the ingredients for a turnaround.
Yeah.
We're just not seeing evidence of that yet.
Nice use of language, ingredients. You're always doing your homework, man. Let's go to our next one. Another company that was fantastic in its day, IDP Education. IEL is the ticker code. And I remember that one of the turning points for this company is when they lost a lot of contracts from universities in basically helping them accept foreign students or whatever. What are you seeing with this one?
So in some respects, it's similar to Domino's in that the longer term trend is down, but shorter term, it is starting to make a bit of progress. So this chart only goes back about a year, 18 months, but we could see since June, it has been making these higher highs and higher lows. So short term, it's starting to head the right way. And it looks like a bit of a buy on the dip at the moment,
Yeah.
as long as you run a tight stop loss.
Yeah.
If you're a little bit more conservative, you want it to trade above this blue line. Now, this blue line is the 200-day moving average, and that's a really good filter for a long-term trend. So you might be able to pick some short-term trends while it's under the 200-day moving average. You might be able to trade it in and out, but usually I've heard some people say that nothing good happens under the 200-day moving average. So
And
you really want it to be above this line, and then you could start to feel confident that bottom is probably in place, and you can look for the further upside. So look, short term heading higher, but long term.
and see that, like both Domino's and IDP Education, they kind of need like a market noting game changer. Yeah. Like the fat-free pizza, it tastes as good as pizza. And then these guys, a big contract from an overseas university or a government bringing more foreign students in or whatever it might be, it seems to me they just need some real game changer.
Yeah, but sometimes the better opportunities is when it starts heading higher and you don't have that announcement yet. So often the smart money will move in and the charts will indicate that something's going on. Something's something's brewing. And then they clear announcement. Something's cooking. Proper money's starting to position.
Yeah.
And if that happens, that would be quite interesting. But at the moment, we don't quite have that. We have a bit of buying.
Yeah.
But it doesn't look like any serious buying yet.
Yeah. Consensus view is up 15.4% for IEL. Only know that. What do you think about that company?
So this is a chart going back 5 years. To me, it doesn't look interesting. Unfortunately, we could see that I guess for the last few years been pretty range bound. There's been no progress. There's doing no money. Yeah. If you're a short-term trader, you might have been able to play these swings, but even just looking at what it's done over the past few months, I mean, it tried bouncing here, pulled back, tried bouncing again. This is a weekly chart, so it looks like in the past several weeks it's tried rally, but again it fell short at this peak from about 5-6 months ago. So it's still encountering quite a bit of selling. So I think until it can crack these levels here, which is around sort of $1.70, $1.80, I just think there's too much selling and we're likely to see it get pushed closer to $1 again. So again, early days for point A.
Sounds like you're strongly supporting the short sellers at this point in time. Let's do another interesting company, Flight Centre.
Yeah.
And look, this goes back about a year or so.
Yeah, so this chart goes back to the middle of last year. So this is a daily chart.
Yeah.
Look, sometimes it's all about the ones that you don't buy, Peter.
Yeah. Well, and originally, being said, in my story, I looked at Flight Centre since 1999, and what I've found historically is that when this company gets written off, Spruto, the CEO, found he rarely comes up with he pivots and the share price shocks the market and it comes back. And once again, it's a bit like the other two companies. Flight Centre might need something to make a pivot, but in terms of the analysts, that consensus rises 25.5%. What's this chart telling out?
It looks like it wants to go lower first.
Yeah.
So, look, if we look over the past few years, it's pretty much rose after COVID, and then it's been rolling down, and we can see in the past year and a half now rolling down. So if I have a look at what it's been doing in the past 6 months, I mean, at first glance, you think, okay, well, is this building a base? But I think there's more weakness, to be honest. I think it might break the lower end of this area, because what we could see is in April went down towards these levels just under $12. It initially bounced, came all the way back down, bounced again, but it couldn't quite crack this high. So what it's telling us is the sellers, they're not even waiting for it to get to $40. They've stepped in and sold it down. Yes, it bounced, but again, before it can overcome these previous highs, it's been sold back down. So we've got some lower highs, which indicates still a lot of selling pressure. And look, the market's moved on from the April lows. This thing's still down at these levels. Yeah. And this is now almost the fourth attempt at these lower levels. And a misconception, and I've mentioned this on the show, a misconception is that, the more you test a level, the stronger it is. It's actually the opposite. It's the more you test it, the more you weaken it. So the fact that this is still down on the mat and can't get itself off these sub $12 levels is telling me that it's at risk of another attempt down there, and it's going to run out of buyers and it'll all right through. So I think if you got your eye on Flight Centre, don't rush in. You might be able to get it quite a bit cheaper.
Yeah. Graham Turner might send you a very nasty email on that. Next is Telex, TLX. Here, the analysts, and there aren't many, 91.2% upside. Is there any good news for Telex shareholders?
Again, we're not looking at a great chart, unfortunately. I mean, when we were just had it right up until brilliant, and then we were involved at that point until we got out with our trunk stock. But we could see that, the left-hand side of the screen, great uptrend. And then this is almost a mirror image on this side here. So every time it tries to rally, it's getting sold into. So we could see the lower highs indicating that there's still a lot of selling pressure. Even here just recently, it shot up, had a great day. But as soon as it got near that high, the selling kicked in, and it's basically back to where it started. Well, that big jump last week. So the analysts seem to like it, but where's the money? Where is the buying pressure?
What kind of people do this? Write it up, sell that. Can you describe that kind of investor or trader?
Yeah, look, you might be someone that's just fed up. So you've seen that jump, and you think, well, I'm out of here.
Yeah.
Or you might
I'll cop that loss and buy it.
Yeah, well, you might have bought it a long time ago and you've got a great profit and you're kicking yourself, you didn't sell it up here. Yeah. And you're just looking for any sort of bounce to get out, or you might have bought it thinking that, okay, I've got to listen to these analysts, and then you're sitting at a loss, and then you see this jump, you think, I'm going to get out at break even and move on. Because there's still a lot of uncertainty as to what might be happening in this company. I mean, they may well be right. It may well be a great opportunity, but put your money where your mouth is. I'm not seeing the money flow in to get this thing off the cans.
Everyone in Billy Joel's song. I might be right, I might be wrong, I might be crazy. Okay, let's go to our next one. And this is a really interesting company. And I can see that the chart is not building up my confidence in it, but the story is a good story. It's called Digico Infrastructure REIT. And they invest in data center real estate products. What does the chart tell us?
I do see a positive. So yes, it is falling away.
Yeah.
But if I have a look at this sort of trading range since it spiked there in June, there is a bit of a channel here. It's still making the lower highs and the lower lows. But what's interesting is after jumping solidly here in August, it didn't get sold back down sharply like in this situation and that situation. So what we've got is a stock that's hugging the underneath of this blue line. So yeah, sort of the opposite of Flight Centre, where Flight Centre's sitting right at the lower end and it can't get off that lower part of the range. This one's holding up near the upper end of the range. So that's actually a positive sign. All we need now is to see a break above this blue line. So it may not happen, but it looks like it's building up to a move.
Yeah, and what surprised me, because I didn't know much about the company at all. I think occasional subscribers to the Switzer Report during Boom Zoom have asked me about this company. But I did a bit of homework when I saw that the analysts had it as a short stock. And I think it was about 5 out of 5 liked it. And like all 5 had a big number on this. So I think that the argument is, well, interest rates are coming down. That's good for REITs. Data centers are the future. So there's a lot of reasons to think that this could be a stock to hold for the future, maybe not very short term.
Yeah.
Final one, Mesoblast.
So I'll put a shorter term chart here because without the long term chart, it's been very disappointing. But it does look interesting. I mean, I think you asked me about this around around this area, and it did go a bit lower. And I did like the look of this shorter term because, and I had this pullback here. It looked like it formed a bit of a base, jumped up, and
That was
like
like aimed with FDA approval for one of its drugs.
yeah, and at the time it was holding in pretty well at these levels. But what's interesting, sometimes you learn more from the failed moves than you do in the ones that sort of work out. What I mean by that is that it looked like after enjoying a period here of sort of hovering around that sort of 230, 240 level, it broke down, and a lot of investors would have seen this sort of sharp move down in a couple of days and think, oh, typical has. Yeah, I'm out of here. This thing's not working. It's going to go, yeah, another one of those, another one of those. But it didn't break down. It didn't fall all the way down to support. It quickly ripped higher, and now it's back in this range again. So this failed breakdown is actually a really bullish sign. And there's a very good chance we do see it rip higher. So, but it's back above this. It's back just under this resistance line. So just near 260. So again, instead of spending all its time down here, it's spending most of it up here. So it does look like it's poised to overcome any final selling and make a bit of a run for it.
Okay. Well, look, the reading of what's going on with the various drugs all look pretty positive. But once again, you've got Donald Trump in there, not being favourable to international businesses and whatever, but still, it's interesting. So from your point of view, we've got Digico, Infrastructure, REIT, and Mesoblast. They're probably the two most promising of the seven. Great stuff. Thanks for joining us.
No worries. Thank you.
First, Mike Gable and Luke and I christened the seven I'm looking at tonight, not as the magnificent seven, but the much maligned seven. Thanks for joining us, mate.
Thanks, Peter.
And that's Mike Gable of Fairmont Equities. My next guest is Jordan Eliseo, General Manager of ABC Bullion. This is a business that deals in gold for retail buyers of gold, for investors in gold. It's been a well-established company. And Jordan, I first met him when he was the chief economist there, but now he's a general manager. And I wanted to pick his brains on what it is we should know about investing in gold. And in particular, I'm going to ask him, has gold got more upside after a spectacular rise in the gold price? So let's catch up with Jordan Eliseo.
Always a pleasure to be here.
Yeah. It's been an extraordinary run for gold over, I guess, the last 3 or 4 years, but correct me if I'm wrong if it's longer. How come? For people who got no idea why gold's gone through the roof, and for those people out there who think they've missed the boat, tell us why gold has gone so high.
Sure, I'll do my best. Obviously, it's a bull market that has been running in totality for about 25 years now, since the turn of the century. But definitely the last 6 or 7 years has when it's really started to accelerate. So actually, even before COVID hit, although COVID gave it another leg higher, and then in the last 12 months, we've seen a real rally. Gold and silver are up the better part of 40 or 50% respectively. There's several reasons that have driven it, Peter. Obviously, in more recent times, rates are starting to come down, and so that's encouraging investors to look for alternatives. A lot of people realize that central banks are very, very significant buyers in the precious metal market now, adding gold to their holdings, and so people feel confident investing in gold because they think, wow, there are these huge buyers that are also in the market. That gives them some confidence. Obviously, since Trump's return to the White House, there's been a lot more uncertainty around trade and tariff policy. It hasn't hit the equity market yet, but I think people are a little worried about that. And the last one is inflation. And again, inflation has pulled back from where it was in the immediate aftermath of COVID, but inflation rates are still at problematic levels if you're a central banker. So I think, even here in Australia last week, the monthly inflation figures were around 3%. So, all of those factors have combined to put a real or multiple tailwinds under the gold price, and that's why it's performed as well as it has.
Have you actually worked out what are the percentage of investors who are committed scaredy cats?
Maybe 10 or 15% of our clients would fit that profile. I love the term scaredy cat, very technical term. But no, like, maybe it's 10 or 20% that are buying gold purely as oh my God, I think something really bad's going to happen and gold's the best way of protecting wealth. The other 80% or so, though, are much more buying gold as a diversified part of their portfolio. So, if I look at our SMSF database, and that has grown exponentially in the last 15 years, going back to the global financial crisis, most of our SMSF trustees would still have 70 to 80% of their portfolios in traditional investments, in shares like CBA and other, blue chip dividend payers. They'll have money in the banks, term deposits and the like, but they've allocated 15, 20% of their portfolio to gold. And they're not doing that purely out of fear per se. They're doing that as a sensible allocation in the environment we're in, because at the end of the day, especially once you factor in inflation, cash just doesn't generate what it used to. Go back 20 years, if you were willing to lock your money away in a 3-year term deposit, you probably got a 3 or 4% real rate of return. Now you get basically zero. And if you look at the equity market, again, most trustees have pretty healthy allocations to equities. They're happy with the dividends, but they also get that there are pullbacks in equities, that the market doesn't just go up. And so gold has played that very natural portfolio diversifier. So yes, there'll always be an element of the gold market that it's kind of exclusively a fear trade. The bigger part of the market is people holding it as part of a portfolio. And then I'd say more recently, and this is probably where metals like silver and platinum come in, Peter, people are actually buying it with a pure profit motive. They just see that gold and silver and platinum are going to outperform more traditional assets. And so they say, well, I want exposure to that in my portfolio.
Yeah. Are you seeing many clients at ABC Bullion who buy maybe for 6 months or a year, they make a bit of money and they actually take profit?
Absolutely. So if you look at the last couple of years, for example, and in the last couple of years in Aussie dollar terms, gold's gone from, it hit $3,000 in about March of 2023. So last 2.5 years, it's gone up $2,500 an ounce. The turnover that we're doing, it's sort of gone towards effectively record levels, but the composition of that turnover, quite interestingly, a bigger share than ever before has been metal coming back. So clients actually selling. And I think, Peter, in most instances, in some instances, it's clients thinking, I think gold's had a huge run and there's better route taking profit. More often than not, though, it's people selling for 2 reasons. Number one, they actually want to reallocate to another part of their portfolio because their gold exposure has become such a bigger percentage than it was when they started. So it started at 20%, it got to 35%, they take 10% off the table. So they're not walking in going, oh, I'm bearish on gold now. They're just saying it makes sense to effectively reposition the assets. And the other one, and this is probably becoming less of a thing now because rates are starting to come down again, but there's definitely a segment of clients going, my God, I've made this huge gain on gold. I've got a bit of debt left, maybe some of the mortgage left or whatever. I'll cash in this win and deleverage my household balance sheet, as it were. So there's been some selling. Less of it is, I just think gold's had its day now. It's more for those other reasons that I discussed.
So if I go back, I've been lucky enough to be an investor in precious metals for just over 20 years, and I've worked in the market for over 15 now. One of the real stories that we've often tried to communicate, and it's a more difficult one for those of us in countries like Australia or the United States, the UK, to grasp, is that exact story that you're telling. So typically here in Australia or the US, you'll talk about the Fed and you'll talk about inflation and you'll talk about gold's relationship with the S&P 500 or the Dow as being drivers of gold. Now, all of those things are true. But what has absolutely happened in the market, as you've spoken about, is that in the last 20 years, the amount of wealth, the amount of economic output coming out of gold-friendly buying nations, China, the rest of Asia, India, and the rest of the subcontinent, the Middle East as well, it has exploded. And so right now, between central banks
and those key consumer markets, those let's call them buying groups already account for about 3,000 tons of gold demand a year. So yeah, that's become a much more significant factor.
And how many tons would it have been, say, 20 years ago?
Oh, barely half. And if you look at central banks, I mean, central banks were net sellers 20 years ago. They turned net buyers when the GFC hit and have been buying ever since. And the pace at which they're buying has only gotten stronger.
Okay, before I get to the really easy question, like where is the gold price going to go? And I know in this show wants to know exactly that. You better be right. Here's another question. Are you finding younger people who can't buy property, cut their teeth on Bitcoin and Ethereum and all the other cryptocurrencies, have they started to show interest in the precious metals because it's just been doing well? And they read, they're on the internet, they're on Robinhood and all the other cheap brokerage websites. Are they interested in gold and silver and whatever?
Absolutely. So if I could start even with a little ABC reference, because and the reason being, because we, obviously serve so different investment demographics here in Australia, the share of demand that we're seeing from people sort of age 35 and under has effectively doubled in the last 3 or 4 years. And that's partly because, number one, the gold price has done so well. Number two, as you pointed out, a lot of those people were originally interested in crypto. Some made some money in crypto. And of course, crypto's always marketed itself as digital gold. And then the third thing is obviously, some of the products that we've brought to the market, like our Gold Saver program, have made it really easy for clients to get into gold. I think there's another element though, Peter, and that is that, if you think of someone that's 30 to 40 years old now, they were very, very young, maybe teenagers or so when the global financial crisis hit. Their entire, let's call it adult life, has been one that's been characterized by higher economic uncertainty. And in that period, they've mostly seen the gold price do very well. So it's kind of natural that they are, for want of a better term, quite warm to the idea of buying gold. And whilst most of those people are still at the younger end of things, their wealth is building. They have been putting money into super for 10 or 15 years in Australia. They're sort of starting to move towards higher income, if not yet peak income earning years. So those tailwinds have all been pretty supportive for gold as well in terms of rising demand from that younger demographic.
Okay, great story. I don't think anyone would have turned off this interview, despite the fact we have two economists talking about financial stuff.
What else would you rather listen to?
Yeah, I'm on economic headed here. But the big question is, given the fact the price has gone up so high, what's your outlook for the next year?
It's a great question and one we're getting a lot right now. If you look at periods, so let's take the last 25 years in which gold has been in a very clear bull market. It obviously hasn't gone up in a straight line. And so in periods where it's gotten as frothy as it is right now in terms of the speed of the gains we're seeing, it hasn't been uncommon to see the market consolidate by around the sort of 10% mark. So I think that could very easily happen again. Now, whether that takes 3 months or 6 months to play out, the market could go another 10% higher before this happens as well. There's a lot of people that think it'll hit at least $4,000 in this current office around the 3.7 mark. So look, if you were asking me to guess where it would be 6 weeks or 6 months from now, it wouldn't shock me at all if it's kind of around where it currently is, or has even pulled back a little bit, because that's a very healthy and natural part of a bull market cycle. If you ask me where I think it'll be 6 years from now, I think the price, like I've said for many years, will continue to rise because all of those tailwinds are fundamentally still in place. So I don't think people should expect the gold price to rally 30% or 40% year on year like it is right now, depending which currency you're looking at. But the fundamental tailwinds supporting this bull market, I think, have many years to play out, and so prices will rise over the medium to long term.
So certainly, I guess what you're implying, that you'll never say it because ultimately you do work for a gold company, though I've always said you're very objective, that if a pullback happens, buying the zip would not be a dumb strategy.
I think that investors would probably be pretty well rewarded if they adopt that strategy. Correct, though.
Okay. One last question is, if you had to look at your own personal portfolio, how much would you allocate to gold generally? Not necessarily specifically now, but if someone was putting together a portfolio, with blue chip stocks and term deposits, what percentage do you think is a sensible starting point?
Great question as well. And obviously each investor is unique. And, I'm in my mid-40s now. So, if I look at my SMSF, my SMSF by definition should look different to someone who's in retirement in terms of asset allocations and the like. Look, I think there's plenty of investors that are allocating somewhere between 10 at the lower end and 25 at the higher end. Interestingly enough, Morgan Stanley, their CIO, only I think 2 weeks ago came out and spoke about the asset allocation and said, look, the whole 60-40 model should probably be adjusted now, and maybe it should be 60-20-20, and the 20 should be in gold. That's not investment advice. Every individual person is different. But I think if people own something like 10 to 20% of their portfolio in gold, they have enough gold that it can meaningfully make a difference. It can meaningfully boost their returns. It can meaningfully balance and protect their portfolio. But it still gives them plenty of money in those traditional assets that they're more used to. And they don't go from being unexposed to gold to now being totally, like only concerned with the gold price, if that makes sense. So yeah, that's probably the best way I can answer that, Peter.
You did remind me of something, which means I have to ask you another last question. There was a time when I was on Twitter, which is, what's it called now? It's called X, I believe. It's called Twitter. And I always thought, well, I wrote a really good story. I should let people know I wrote a good story. And there's a time there where the whole world thought the world was going to go to hell in a handbasket. Would have been after the GFC. And the people who used to rip into me and hate me for being optimistic, and by the way, Australia did go 20 years without a recession, so I wasn't right. I thought it was a good call. And when people criticised me, I rarely look up to see if they had any economic credentials, and generally they didn't. So I called them Bush economists, and they hated that as well. But there was a period around, I guess, post-GFC when gold just didn't do anything at all. What was that time, and when did that? Because this is a 25-year period, but there was a period in the middle where it went sideways or stayed low for a long time. So people didn't make any money for a while. If they stayed, they're killing it and they're laughing their heads off now. But they had a really tough time, and they hated me as a consequence, saying, look, I think we'll get through this. I think they'll cut interest rates. What was that time period?
Yeah, in US dollar terms, it was from basically late 2011 to the end of 2015. So that was, that sort of
4 or 5 years.
Yeah, I mean, you would have had to have been unlucky, and you would have had to have bought the absolute top of 2011. But yeah, that was roughly the period. In Aussie dollar terms, the correction was far more modest because obviously the currency started weakening. But yes, that was essentially the cyclical bear market within this 25-year secular bull market run. And that can absolutely happen. I think one of the things to just some data points to contextualize that period and why maybe now's a little bit different. Firstly, if you look at the S&P 500, look at global equities as an example. I think the S&P was below 1,000 points at the lowest point of the GFC. It's obviously much higher now, and price earnings ratios that investors are buying are much higher now. But even if we just look at gold individually, Peter, if we look at, and this is a good way of sort of gauging sentiment in the gold space, in 2011, if we look at the United States, gold ETFs were more than 8% of the entire US ETF market was just comprised of gold ETFs. That number today is closer to just 2%, right? So as a share of investor portfolios, for want of a better term, gold is still pretty under-owned, whereas by 2011, it had been in a 10-year bull market by that point. Obviously, it's easy with hindsight now, but it sort of did need a breather, if that makes sense.
Yeah, without a doubt. And it's interesting, mate. People think that, you know, 24 karat gold investors like property, that you can never not see the prices rise. But, yeah, around 2011 to 14 or so, Sydney house prices went absolutely nowhere.
Yeah, absolutely.
Yeah.
Yeah.
All right, but that could be wrong. But certainly there was a time when people who thought prices never fall, yeah, they can fall, but not by much. Thanks for joining us, mate.
My pleasure, Peter.
And that's Jordan Eliseo of ABC Bullion. Thanks for joining us on the program. As you can see, we do look at things that you really should know about if you want to be an investor. And so if you want to learn more, think about becoming a subscriber to the Switzer Report. It's less than $400, and it would be the best $400 you'll ever spend. So go to switzerreport.com.au, and remember, Switzer Daily is somewhere you can go on a daily basis to see what I'm thinking about the economy and markets and a lot more. Thanks for joining us. See you next week.